Hey everyone, welcome back to Corporate Decoder. Today, ALTEX Industries Inc. just filed their quarterly report, and I am seeing a story of survival and very slow movement. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is reporting some income this quarter, but the overall picture remains challenging, with a lot of deferred compensation hanging over them. Alright, let's dive into ALTEX Industries Inc. Its latest quarterly report, the Form 10Q covering the period ending the 30th of June 2026. This is essentially a snapshot of their financial health 3 months at a time, and 9 months of the year. First up, the balance sheet. This is like a financial snapshot of the company's assets, what it owns, its liabilities, what it owes, and stockholders' equity, which is the owner's stake. As of the 30th of June 2026, the company had total assets of about $2.67 million. That is down slightly from about $2.74 million at the end of September 2025. One of the most important things to look at is cash. They had about $2.47 million in cash and cash equivalents at the end of June 2026. This is down a bit from about $2.54 million in September 2025. While it is not a huge drop, it shows they are using more cash than they are bringing in from their core operations. On the liability side, things are pretty small. Accounts payable were only $2,000 as of the 30th of June 2026, a big drop from $7,000 in September 2025. This means they are paying their immediate bills very quickly. Now, here is something interesting. Accrued expenses, related party stands at a hefty $1.235 million for both June 2026 and September 2025. This is a significant amount, and the filing tells us it is accrued but unpaid salary and bonus, and related payroll tax liability due to the company's president. He has elected to defer this payment, and he can decide to have the company pay it at any time, either in cash or company stock. This is a huge chunk of their liabilities, and it means the president could, at any moment, demand a large sum of money or stock from the company. Looking at stockholders' equity, it is $1.286 million in June 2026, down from $1.342 million in September 2025. This decline is mainly due to accumulated deficits, which we'll see more of in the income statement. Moving on to the statement of operations, this tells us how the company performed in terms of revenue and expenses. For the 3 months ended the 30th of June 2026, they actually reported a net income of $21,000. That sounds good, right? But it is a stark contrast to the $12,000 net loss they had in the same period of 2025. Their revenue from oil and gas sales is tiny. It was $6,000 for the 3 months ending June 2026 and $5,000 for the same period in 2025. For the 9 months ended June 2026, it was $17,000 compared to $14,000 in 2025. These are incredibly small numbers indicating that oil and gas sales are not a significant driver of their business. General and administrative expenses, which are costs like salaries, office rent, and other overhead, decreased from $257,000 in the first 9 months of 2025 to $186,000. In the first 9 months of 2026, the report explains this decrease is mainly because in the quarter ending December 2024, they recognized a large bonus expense and related payroll tax liability of $94,000, which did not occur in the 2026 period. So, this looks like an improvement, but it's largely due to a one-time expense in the prior year. Interestingly, in the 3 months and 9 months ending the 30th of June 2026, they recorded a gain on sale of assets of $49,000. The report clarifies that effective May 1, 2026, the company sold certain oil, gas, and mineral interests in Utah and Wyoming for $49,000 cash. Since the company had a zero basis in these interests, the entire amount was recorded as a gain. This is a significant positive contributor to their net income for this period. Interest income also played a role. It decreased from $88,000 in the 9 months of 2025 to $68,000 in 2026. This is because of lower interest rates on their cash balances. While the income is lower, it is still a substantial source of money for them, especially considering their tiny oil and gas sales. So for the 9 months ended the 30th of June 2026, they had a net loss of $56,000. This is better than the $160,000 net loss in the same period of 2025. The small profit in the 3 months of 2026 was offset by the losses in other periods. And per share, it is still a tiny fraction of a cent loss. Now let's look at the cash flows. This is crucial because a company can report profits but still run out of cash. For the 9 months ended the 30th of June 2026, they used $120,000 in operating activities. This means their day-to-day business operations are costing them more cash than they are generating. This is up from $78,000 used in operating activities in the same period of 2025. The investing activities show the $49,000 from the sale of assets we saw earlier. This helped offset some of the cash drain from operations. Overall, their cash and cash equivalents decreased by $71,000 in the 9 months ending June 2026. This is an improvement from a $78,000 decrease in the same period of 2025, but it still shows their cash balance is shrinking. Looking at the statement of stockholders' equity, we see how the equity accounts have changed. For the 9 months ended the 30th of June 2026, the company had a net loss of $56,000, which directly reduced their total stockholders' equity. As of the 30th of June 2026, their accumulated deficit, which is the total of all past losses minus any profits, stands at a substantial $12.5 million. This shows they have a long history of losses. The notes to the financial statements provide more context. It states that these statements are unaudited and prepared according to us generally accepted accounting principles. Importantly, it notes that the results for the 9 months are not necessarily indicative of full-year results. It also mentions that there were no potentially dilutive shares as of the 30th of June 2026. Meaning no stock options or other securities that could significantly increase the number of shares outstanding and dilute existing shareholders. Then there is the safe harbor statement. This is a legal disclaimer where the company warns that any statements about the future are just predictions, and that actual results could be very different due to various risks and uncertainties. They mention things like economic conditions, oil and gas prices, and their ability to find and develop new properties. It is a standard part of these filings, reminding investors to be cautious about forward-looking statements. Now, for management's discussion and analysis, they reiterate the sale of assets for $49,000 and the gain. They also highlight the negative cash flow from operations, stating the company is likely to experience it unless they invest in producing oil and gas wells, or another venture that generates sufficient cash flow. This is a pretty direct admission of their precarious financial situation. They are very clear here, without new investments that bring in steady cash, they will continue to have negative cash flow. They also mention that their only sources of liquidity besides operations, asset sales, and interest income are their working capital. This means they don't have a lot of readily available cash from external sources. Under results of operations, they explain the decrease in general and administrative expenses due to that large bonus expense in the prior year. They also mention the decrease in interest income due to lower rates. They conclude that at current levels of production, cash balances, interest rates, and oil and gas prices, their revenue is unlikely to exceed expenses. This means they expect to continue making losses unless they make significant changes. Interestingly, they include a statement on climate change, saying they do not believe it will have a material impact on their financial condition or results. This is a common disclosure now. The controls and procedures section is about how the company ensures its financial reporting is accurate and timely. Management states that their disclosure controls and procedures are effective. This is a required statement for public companies. Finally, the exhibits list the supporting documents, including certifications from management and XBRL financial data. The report is signed by Stephen H. Carden, the Chief Executive Officer and Principal Financial Officer, dated the 31st of July 2026. So, what is the story here? ALTEX Industries is a very small oil and gas company with tiny revenues from its core business. They are heavily reliant on interest income and asset sales to bolster their financials. The most significant overhang is the deferred salary and bonus to their president, totaling over $1 million, which could be called due at any time. While they reported a small profit in the most recent quarter, largely due to selling some assets, their operations are still losing money and their accumulated deficit is substantial. They are very open about the fact that they need new ventures to generate cash flow to avoid continued losses. It's a company that's treading water, and its future hinges on finding a way to significantly boost revenue or secure new investments that can turn its operational performance around. The large deferred payment to the president is a key risk to watch, as it could significantly impact their liquidity. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.